Good morning and welcome to another webinar in our series, Pulling Back the Curtain. Today, we're going to talk about dangers in gifting and how it can hurt you when you are trying to apply for Medicaid to pay for long-term care, to pay for nursing homes. If you need to go into skilled care, go into a nursing home. It's very expensive, $10, $12, $14,000 a month. And there are strategies and ways for you to get the government. You're supposed to be broke, and there are ways that we can help actually protect a lot of your assets. So while you qualify, um, you don't necessarily have to be totally destitute. And a lot of people have the misconception of thinking, well, Medicaid, I got to be poor, and it's not really true. And in fact, if you're in a nursing home right now and paying $10, $12, $14,000 a month, you probably want to call us because we can protect a lot of your money, especially, we deal with what we call the intersection between real estate and elder law, and homes are part of everything we do. So let me try and share my screen with you. And we'll go through the presentation. And if you have questions as we go along, just enter them in the chat and we'll try and answer them as we go along. So again, there's a thing called a 5-year look back. And if you give away your money during 5 years, right before you need to go into a nursing home, there's a thing called a penalty. And that means Medicaid, the government, won't pay for your care in a nursing home to the extent that you gave money away. So if you give away $100,000, the first $100,000 is on you, basically. Yeah. These are just a little bit about me. I'm an attorney. I've been an attorney for over 3 decades. I'm members of the Pennsylvania and Allegheny County real property and probate sections. I'm a certified financial planner, a registered investment advisor. I've written several books, one of which is about how to protect your money, your savings against from the cost of long-term care. And if you want a copy of that book, you can get that on our website, keitheliou.com. By the way, we do these webinars every Saturday morning when we're not on KDKA radio. Usually we have a show once a month on KDKA at 8 a.m. These webinars usually are at 9. Today we're actually doing 3. We're doing one on this plan, this program, and we're doing 2 other ones on real estate, one for sellers, one for buyers. So here's the agenda for what we're going to talk about. We're going to talk about this thing called the look back period. A lot of people get confused about what that is. We're going to talk about what the penalty is for giving away money. You may be surprised to know what is considered a gift, because you and I probably wouldn't consider it a gift. We're going to talk about paying children to help you around the house. That can create a problem if you go to apply for Medicaid for help to pay for the nursing home. And there is a rule where you can give away $500 a month, and we'll talk about that, and you don't get penalized for that. What's the look back period? So it's the 60-month period from the time you were otherwise eligible. What's that mean? That means when you are, there's 2 parts to getting qualified for Medicaid to pay for the nursing home. One, you have to be medically eligible. That means you have to be nursing facility clinically eligible. You need help with 2 or more activities of daily living: bathing, eating, dressing, continence, transferring, toileting. So if you need help with 2 or more, you probably are medically eligible. And there are forms that the doctor and or the facility would have to provide to show that you're medically eligible. You also have to be financially qualified, and that means depending on your income, if you have income of $2,532 a month or less, you can keep $8,000. If you have income more than that, you can keep $2,400. So, once you meet those 2 criteria, medically and financially, you're both medically and financially eligible, and you request Medicaid to pay for your care, that in that date, 60 months before that, are the months that the government looks at, the county assistance office, to see if you made any transfers for less than fair consideration. And if you have, that creates a penalty. And again, to the extent that you give away money that you could have used to pay for your care, then Medicaid's not going to pay for the nursing home. Here's an example. Grandmother gives $20,000 to her grandchild to help pay for a wedding in June of 2020. So July 1st, 2022, grandma enters the nursing home, and asks Medicaid to pay for the home that's $14,000 a month. Medicaid wants to pay for the nursing home for $20,000 divided by the daily divisor. Daily divisor is $482.50 a day, or 41.45 days, rounded to 41 days. So first 41 days, grandma is not going to have the government Medicaid paying for the nursing home. So in this case, if she's otherwise eligible, it's meaning she doesn't have any money. She's got less than either $2,400 or $8,000. Who's going to pay for that first 41 days of care? And that's the problem. That's what you want to avoid. Now, if we get involved early enough, sometimes we can fix this, and there are some strategies we can use to try and help get through these 41 days. But this is a problem. If grandmother doesn't have money, there's a thing called the filial support law. I think that might be the next slide. These are, according to the Department of Human Services, the average daily private pay rate is $14,676.04 a month, and that means the daily rate is $482.50. Those are the numbers that they use to decide the period of time that they're not going to pay for it. Again, the transfers are anything for less than fair consideration. If you give it away, you don't get anything back. And we're going to talk about what is a gift. That's the thing that creates the penalty. So if you buy a TV, that's not going to be a penalty. If you buy a car, that's not a penalty. But if you give your children or grandchildren money to help them buy a house, pay for a wedding, pay tuition, all that stuff is going to be considered to transfer for less than fair consideration. Here are some examples. Okay, so wedding presents. You wouldn't think that they would call these gifts. Birthday presents, giving money to a child to buy a home, paying for school tuition, unexplainable withdrawals from an ATM. That's a problem. If you just use your ATM card whenever, at random, whenever you need money, and you can't explain where that went, even though you use that for yourself to pay for things, the county assistance office is probably going to call that a transfer for less than fair consideration and count that as a penalty. So you want to actually pay for things with your debit card. So there's a receipt rather than taking cash from an ATM and paying cash for something. If you add your child to the title on your house or give it to them for $1, that's going to be a transfer for less than fair consideration. Paying your child to help you around the house, and we're going to go over this in a minute. Again, you wouldn't think that would be a gift, but if you start writing them checks for $1,000 here and $1,000 there, that's going to be determined to be a gift, and you'll get penalized for that. Giving your child money to go shopping for you, again, it's better for you to use your card or use a credit card to pay for the groceries and things that so you have a paper trail, a receipt. So it's not considered a gift. Transfers to a revocable trust. We're going to talk about this in a second. If you have your house is typically exempt, which means that while you're alive, it's not a countable resource for when they determine whether or not you're eligible for Medicaid. So if you've got your house in $2,400, you're going to be eligible. There's a thing called a state recovery on the other end. That's a problem. But if you put that same house into a revocable trust, it becomes countable. So people, if you've been told, oh, it's a great idea to put your house in a revocable trust, not for Medicaid purposes. And again, we're going to get to the $500 exemption. Exceptions to the gift penalty. Okay, there's a rule that says if you made a gift for a purpose other than to qualify for Medicaid, then it wouldn't be penalized. That usually doesn't work. Most transfers, if you can't explain where the money went, or even if you can explain where it went, it's very high standard for you to prove that it's for a reason other than to qualify for Medicaid. The county assistance officer is just going to say, it's a gift and you're going to be penalized. If you can get the money back, you can cure the gift, okay, but usually the money's gone. So that's a problem. If you can show you got fair market value back, again, if you actually bought something, if it was a sale, then that's an exception. I mean, you're not going to get penalized for that. If you give a gift to a blind, permanently or totally disabled or minor child, right, So blind, permanently and totally disabled, or a minor child or a spouse, and transfers to a special needs trust for people under the age of 65. That's just the site there of the law where you can find this rule. That is not going to be penalized. Okay, so if you gotta watch if you give something to a disabled child of yours, you don't want them to lose their benefits, so you probably are going to transfer that to a trust. Sometimes you can give your house away without a penalty. Okay, here's some exceptions. A child caregiver, if you've got a child that has lived with you for at least the last 2 years, and you can get documentation from a doctor that says, yes, because they lived with you and helped you for the last 2 years, they delayed you from going into a nursing home. Otherwise, you would have been in a nursing home sooner. You could actually transfer the house to the child caregiver, not a grandchild, not a niece, not a nephew. It's got to be your child. They have to have lived there for the last 2 years, and because they lived there in your house for the last 2 years, their care kept you from going into nursing home. You could actually give your child your house, and it wouldn't be penalized. There's a step-up issue there. If they're going to live in it and continue that for that to be their residence, then that's not a problem. If they're not going to continue to live there, they could have a capital gain issue, and the tax of capital gain is, the 15 to 20% could be more. So it's important to know whether or not they plan to live there. Here's an exception, doesn't come up very often because usually people that are going into nursing homes are over 65. If they have a child under 21, they can transfer the house to the child that's under 21. Again, a child who's blind or disabled, you can gift it. You should gift the house to the trust, so you don't knock them off their benefits if they have benefits. A sibling, brother, sister who lived in the house with you for at least the last year and been on title for the last 5, that's not going to be penalized. And there's also a strategy, and it's not really an exemption, that if you're interested, if it applies, we could show you how to, if you've got cash in addition to the house, suppose the house is worth $250 and you have $125,000, we can show you how to gift the cash and have the child use the cash to buy a half interest in the property, and you effectively at the end of the day will be transferring the house to the kid for nothing, and it would not be penalized. And actually there's some benefits that have to do with step up in basis. That's more for another, and we've done other webinars on this topic, but that's a whole webinar in and of itself. We're just trying to give you a highlight of, hey, there's a problem when you gift, but sometimes there are exceptions. Gifting the house. Okay, I mentioned this earlier, to a revocable trust. The house is usually exempt initially anyway, but if you put into a revocable trust, it's going to count. So generally, if you have a revocable trust, they don't work for Medicaid planning. So if you think that you're protected, you said, well, I had all this trust work done, and so I'm good to go. If it's a revocable trust, where you may be the person that created the trust, the settlor, the grantor, you may be the trustee, and you're the beneficiary. So that does not work for protecting assets in this realm. You'd have to have what's called an irrevocable trust, which is a trust where you technically can't get access to the assets. Can the penalty be fixed? Yes, if some or all the gift again is returned, that eliminates the penalty. So if you give away $20,000 to one of your children and they still have the money, or they don't have the same money, but they can give you $20,000 back, you can cure the gift that way. And there are other ways where we can sometimes use, if you have some money left, if you're not totally broke, we can use some money with a special kind of annuity to cure the penalty. Sometimes we can get you approved for a thing called the waiver program, and you can ride out the penalty at home. It's if you can still operate with some help at home from your children. Waiver program, actually, the waiver program's really good if you've got a child if you qualify medically and financially, and you've got a child that is helping you anyway. As long as they're not the agent under a power of attorney, they can get paid by the government through Medicaid to help you. And that may be another slide back here later. Filial support. I mentioned this earlier. If you give away your money, and if all the money's spent and the penalty applies, your children may have to pay the nursing home bill until Medicaid kicks in. It's called a filial support law. So you may be putting your children in jeopardy and risking their assets. You think you're doing a good thing by giving money away while you're alive, but if you need help in a nursing home, it could come around and not only create a problem for you, it could create a problem for your children. They could be required to pay the nursing home. Here's another do-it-yourself issue that we see. Medicaid generally disregards joint ownership. So if you put your child's name on your bank account and think, well, it's been on there for 5 years, and so it's really, at least half of it's protected, doesn't work that way. Adding somebody else's name on the bank account does not protect the assets for Medicaid planning. The county assistance office looks at this as a nullity, so the entire account is counted. And beyond that, if you do this and your child passes away before you may have to pay the inheritance tax 4.5% to the state on your own money. It's really generally not a good idea to add your child's name to a bank account. Better way to do it if you want your child to have access is to create a power of attorney. And we've done webinars on that in the past. You can look at our site, and if you go to our site, keitheliou.com, and pull up the power of attorney webinar, that'll give you some information about why that's an essential estate planning tool. Any type of withdrawals for which you don't have proof of how or where the money was spent. Again, I'm interested in this in connection with ATMs. If you can show a consistent pattern of deposits and the same amount of draws each month for payment of expenses, that could be okay. Show that you get your Social Security check, it's $1,200, it's deposited on the 1st, on the 5th, you take out $1,000 every month. And that's, we've had cases where the county assistance office accepts that because some people pay cash. It's just some older folks have gotten into that habit. But the better practice is to use your debit or credit cards and it'll have a record for you that's easy to show, that if you went to this grocery store, that grocery store, this department store, it'll show that you used your money for purchases and you got fair value back. We mentioned this earlier, paying your child to help you around the house. Payments to family members are considered gifts unless there's a written agreement. Medicaid considers the help of your child as due to love and affection unless you have a written personal care agreement in place, and you have that before you make the payment. You can't do the agreement after you make the payment. So you do the agreement first, and the payment has to be for market pricing. You can't pay your child $500 an hour to help you. And what they do, they've got a document. There should be a little notebook, and every time they help you, they should make notes of the day and the time and what they did and how long it took to help you, and receipts, and staple those receipts in with it. And here's the thing that most children don't like: they should pay income tax on it. Not that the Medicaid office is going to track that down, but payment to household employees is subject to income tax rules, and again, they could create a problem for your children if they don't pay income tax on it. But if they do, and they should, it's more proof for you that the payments were not a gift, so you don't get penalized for Medicaid purposes. And I mentioned this earlier. Good news: if you want Medicaid you can have Medicaid pay your child to help you if you qualify for the waiver program. If you qualify medically, and your income is under the $2,532 a month, and your assets are under the $2,400 or the $8,000. Well, if your income's under $2,532, you're allowed to keep up to $8,000. Your child can help you around your house, and Medicaid can pay them to help you as long as that child is not an agent under the power of attorney. If they are, then maybe they can resign, or we could create a new power of attorney and appoint one of your other children or somebody else as your agent under a power of attorney. It's just an unusual rule that that Medicaid has about, they'll let you have your child help you, and they'll pay for it, but they won't do it if they're your agent. And the $500 rule. Okay, you can give away up to $500 a month total. Okay, total, not to each child, but if you want to give away money and it's not, and you have to take cash from your checking account and give it away, and it's up to five, it can't be $501 because then the whole thing counts, and it can't be $500 to each child or to several people. It's a total of $500 a month. And that's okay, and that won't be penalized. So hopefully this gave you a an idea of how gifting can be a problem, how it can create a penalty. Sometimes there are exceptions to the rules. Sometimes there are ways to cure the gift, but you really want to be careful when you stop this sharing. If you have any questions, here's my phone number, 921-7100, extension 13. My email, keith@eliulaw.com. Call me or email me with any questions. We do Medicaid planning, we do mortgages, real estate, anything to do with real estate buying, selling, title work, closings. We do Medicare. So if you've got questions about any of those topics or anything we talked about today, please reach out to us and we'll be happy to help you. And hopefully you will join us for another in these series of webinars. And every Saturday, usually at 9. Today we've got a triple header, 9, 10, and 11. So thank you again for attending and hope to talk to you in the near future.